Welcome to Oraculum Accounting. In this video, we will explore the topic of auditing. Auditing. This module introduces auditing as a systematic process used to examine financial information, organizational controls, and compliance with established standards. It explains how auditing provides independent assurance that records are accurate, systems operate effectively, and governance responsibilities are properly exercised. Purpose and objectives of auditing. The primary purpose of auditing is to provide independent assurance that financial information and organizational processes are accurate, reliable, and prepared in accordance with applicable standards. It confirms the accuracy and reliability of financial statements, ensures compliance with laws and policies, evaluates internal controls and risk management, detects errors or fraud, and enhances stakeholder confidence. Audit requirements, thresholds, and business reasons. Audit requirements are determined by thresholds such as revenue, total assets, number of employees, or public accountability. Public companies and regulated entities usually require mandatory audits regardless of size. Smaller businesses may be exempt but can choose voluntary audits to strengthen credibility, improve financial discipline, enhance governance, and support financing or expansion decisions. Types of audits and their scope. Financial audits examine whether financial statements present a true and fair view, including verification of transactions and disclosures. Internal audits evaluate internal controls, operational efficiency, and risk management across systems. External audits provide an independent opinion on financial reporting. Compliance audits assess adherence to laws, regulations, and internal policies. Operational audits review efficiency, effectiveness, and resource utilization within business processes. Auditor appointment. Auditors are appointed by shareholders or governing bodies, often based on recommendations from the board or audit committee. They must be qualified, independent, and free from conflicts of interest. The appointment typically applies to a specific financial year, ensuring objectivity and credibility in the audit process. Role of an external auditor. An external auditor provides an independent opinion on whether financial statements present a true and fair view. The role includes testing transactions and balances, evaluating accounting policies and internal controls, gathering sufficient audit evidence, and reporting findings to stakeholders. The auditor provides reasonable assurance, not absolute assurance, and does not guarantee absence of fraud. Steps in the auditing process. The auditing process includes engagement and planning to define scope, followed by risk assessment to identify areas of potential misstatement. Internal control evaluation determines the strength of systems and impacts testing depth. Substantive testing and evidence collection verify financial data through documentation and confirmations. Analysis and conclusion assess whether statements comply with standards. And audit reporting communicates the final opinion. Key areas of focus in auditing and organizational control review. Auditors review risk assessment processes to ensure risks are identified and managed. Segregation of duties is examined to prevent manipulation. Information systems and data integrity controls are assessed, including access restrictions and backups. Compliance with laws and policies is verified. Asset safeguarding ensures protection of physical and financial resources. Financial reporting processes, fraud prevention measures, and performance monitoring through KPIs are also evaluated to maintain strong governance. Outcomes of auditing. Auditing enhances the credibility of financial statements and strengthens stakeholder confidence. Identified errors may require restatement or correction, while control weaknesses lead to process improvements. Non-compliance may result in regulatory action, financial penalties, or reputational damage. Overall, auditing promotes transparency and accountability. Audit reports and actions after the auditor's opinion. Audit reports express the auditor's opinion, which may be unmodified, qualified, adverse, or a disclaimer depending on findings. Businesses must review the opinion carefully, correct misstatements, implement control improvements, communicate results to stakeholders, and monitor corrective actions to prevent recurrence. Taxation Office Audit. A taxation office audit is conducted by a government authority to verify the accuracy of tax returns and compliance with tax laws. It may be triggered by risk indicators such as unusual deductions, inconsistencies, industry comparisons, or random selection. The audit involves reviewing financial records and supporting documents and may result in reassessment, penalties, interest, or confirmation of compliance. Auditing of non-profit organizations. Auditing of non-profit organizations ensures that funds are used according to their mission, donor restrictions, and legal requirements. It verifies income from donations and grants, assesses expenditure classification, reviews compliance with funding agreements, and evaluates internal controls. This enhances transparency, accountability, and trust with donors and regulators. Conclusion: auditing is an independent and structured process that strengthens financial reporting and organizational controls. It ensures accuracy, compliance, and accountability while supporting risk management and building stakeholder confidence. Thank you for watching. Subscribe for more informative content.